In this presentation, we will discuss the possible requirement to report the refund from the state and local governments as income. This one makes sense when you think about it, but it's a little bit confusing to think through as to why it makes sense. And even once you figure it out, it's a little bit confusing to actually put into practice. So let's think it through. Let's consider what's going on here. We have our income tax equation. We're still focusing here on line 1. The typical scenario would be something like you got a refund from the state. For example, if you filed your federal and state tax return last year, let's say that the state was California, then typically you may be able to get a deduction for the taxes that you paid from the state on the federal tax return. And then what would happen is now you got the money back from the state. So you took a deduction for it, but you overpaid it, and now you got the money back from the state. So do you have to then record the refund from the state income tax that you got refunded to you in income on this year's federal income tax return? So this year I got the refund back. I've got a documentation from the state saying that I got this refund back. Do I have to record it in income? Answer, maybe, depends. So here's going to be the type of documentation you would see. So from the state, if you're talking about California, you would get a 1099-G, or any kind of state, any state where you basically got the refund, you should typically get a 1099-G. It may not look exactly like this. However, the boxes will be the same as here, and you should be able to look up the instructions for them on the IRS website if you have any confusions about the reporting of how it's going to be reported. The look and feel of the form, in other words, may be slightly different, but the information within it should be the same. And we're looking here on line 2, which is going to be the state or local income tax refund credit, and so on and so forth. So the typical scenario we're thinking of, state income taxes that we filed. So you'd have to be in a state where you're required to file income taxes, overpaid the income taxes, then we got a refund in the following year. So we paid the taxes in the prior year, and now we're going to get a refund for overpaying them in the current year. Do we have to include that in income on the federal income taxes? So if we do have to do that, it would be reported then on line 7A. That's where it's going to go into the other income. This is the first page of the 1040. That then would be supported by the Schedule 1. So Schedule 1 here, top line, tax refund credits or offset of state local income taxes. Now, when you put this into the software and you don't know the rule, it can be very confusing, because what will happen is you'll put this $500 into the software, you've got the form, you put it into the software, and then it doesn't appear on the Form 1040, and you're going to go, why? And if you're doing this with a client, they're going to go, why? And you're going to have to say, I don't know exactly why, or you're going to have to figure out exactly why that would indeed be the case. Now, if you're entering this into the software just on the current year, the software doesn't have enough information to really know if it should be putting that in place or not, because it would need the last year's return information. This is another reason that if you have a new client and you have the prior year 1040, oftentimes the best thing to do is really to put that 1040 into the prior year software and then roll it over so that the software is now rolling over that information into the current year. Then the software will know whether or not it should be reported. But you're still going to have to understand the rule, of course, so that you can explain it to somebody else. So if you put it into the software and it doesn't show up here, why would that be the case? Well, it's applying the rule that says that you have to have it had been deducted in the prior year. In other words, let's think about last year, what happened with the state and tax refund. Let's imagine we have the federal taxes and then we have the state tax. I'm going to imagine it being California. So the California is different than the Fed, and we had to pay taxes to California. Now there's a rule, and it's confusing. This is why they're trying to remove this rule, or one reason they're trying to remove it, because the state taxes, for some reason, are deductible for federal income tax purposes, which is kind of funny because that links the state and the Fed together in some ways. In other words, the Fed influences the state when that is the case more often. So what happens then on the Fed side, if you have the income tax or the state tax, then you get to deduct it on the Fed side, but you only get the deduction if it's going to be an itemized deduction. So in other words, we'll talk more about itemized deductions later, but if you have the standard deduction and itemized deduction, if you're taking the standard deduction, which more and more people will because it's been going up, then you're not going to have to include the taxes. So if you're talking about someone that's just taking the standard deductions, then you're pretty much positive that you're not going to have them including it. We're talking about the prior year standard deduction, but if you're talking about someone taking the standard deduction this year, they probably took the standard deduction last year, and you'll probably have the tax return to prove that. If there's no Schedule A, then that income is not something you'll have to report you're not having to include it in income on the first page of the 1040. However, if they have itemized deductions, if they did itemize, they may be able to include the state taxes as part of those itemized deductions. And you can see the problem here, because if someone wanted to kind of cheat the taxes on that case, what would they do in the prior year? You can say, I would like to lower my federal income taxes. What will I do? I'll overpay the state. What if I pay the state like $100,000? Because I don't owe $100,000 in taxes, but it's on a cash basis. So I'll pay the state $100,000. I'll deduct $100,000. You can't do this, by the way. I'm just saying this is why the rule is there. Then the state, then you get to deduct $100,000 on the itemized deductions, and then the state in the current year is going to say, oh, you overpaid us, and they're going to give that $100,000 back to us because we overpaid. Well, in that case, we took a deduction that we didn't really have an expense for. All we did was basically give the money, and they gave it back to us, and we took a deduction for it. That's basically what's happening when you have a refund from the state. So if you got a tax benefit, then the general rule is, if you got a tax benefit from the state tax deduction that you took on your federal income tax return, and then you got a refund for it, well, then now you have to include it in the income in the current year. So, and note what the proper thing to do, you would think, would be to go back and amend the prior year, right? Because what really happened last year, you took a deduction and you shouldn't have, because you got a refund from it and you deducted too much. But that would be, you don't want to amend the return. That would be confusing. So what's going to happen? You over deducted last year, and this year you're going to get you're going to have to include the income as income. So you got the income this year, you had the deduction last year. So that's going to be the general rule. It's a little bit complicated to apply, because it's kind of complicated to know how much of a benefit you got from the itemized deductions. And part of the reason for that is because there's limitations on the amount of itemized deductions that you can take, and the itemized deductions only benefit you if they're greater than the standard deduction. So the bottom line is, if you have an existing client and you get a form 1099-G for state income taxes, then you can kind of depend on the software and it'll help you out to determine whether or not this should be deductible or not. And then you need to know the general rule to explain it to someone and know why it's not appearing on the tax return. And that's whether or not they got a tax benefit last year from being able to deduct it. If you have a current or new client, then you want to take their prior year tax return and see if they have a Schedule A. If they don't have a Schedule A for itemized deductions, then they didn't get a benefit from this deduction, and therefore it wouldn't be included on page 1. If they did have a Schedule A last year and they were able to deduct some state income taxes, you may then want to actually enter this into the prior year software and help it to roll forward, because that'll make it as easy as possible. The software will help you out to determine the portion of it, if any, would be taxable under that kind of situation. Seems like it would be straightforward, but let's consider the scenarios that could happen in terms of, what if someone had a Schedule A and had a refund? How would we know how much of that refund, of the state refund, to include on the federal income tax return? Well, it would be either the amount received, the amount deducted on Schedule A in the prior year. So that's pretty straightforward. If we had a Schedule A, we could say that the amount that was received, or the amount of the deduction on the Schedule A, the lesser of the two, or the amount by which the itemized deduction exceeds the standard deduction in the prior year, because that's the only way you're going to get a benefit from it. So if the itemized deductions are really close to the standard deduction, then you got to figure, how much benefit did they actually get from the state income tax deduction, because it's not really the full amount. They got to deduct the full amount on the Schedule A, but really it only took them a little bit over the standard deduction, so the actual benefit is not that much. Therefore, it's the lesser of these three items: either the lesser of the amount received, the amount deducted on Schedule A, or the amount by which the itemized deductions exceed the standard deduction in the prior year.